Good morning, we're here with Daniel Major of GoviEx Uranium, listed on the TSX Venture Exchange in Canada. So good morning, Daniel.
Morning.
Thanks for joining us.
Absolutely.
And I think you're going to take us through your most recent PowerPoint presentation.
Yep.
So over to you.
Yeah, absolutely. I think just kind of a background, and the first page really of our presentation kind of sets out what this is all about. It's a uranium company. What is different is it's a development uranium company, and it's all in Africa. So really that is the bit you're looking at really of GoviEx to start with. We went into Africa simply because Africa has been one of the major uranium producing regions for a long time. I mean, Niger started producing uranium in 1971. It's produced about 8% of the world's uranium since then. A third of all light bulbs in Paris are driven by Nigerian uranium. So, that kind of gives you a context of the importance of the thing. The other thing we like about being in Africa is that permitting pragmatism that sits in Africa. When you've got countries where 60 to 70% of their exports every year are commodities, they drive commodities. If you've got countries where commodities are only 5% of GDP, less impact. So, for example, in Niger, we got our project permitted in 6 months. We also have a fully permitted project in Zambia. Now, that's important because if you're looking at some of our competitors in North America and the like, that can take you 6 to 10 years for permitting. Now, if you believe in the cycle of the uranium market, which we're seeing at the moment, where we're seeing improvement in prices, and we can go through that a bit later in the presentation, you want the companies who can turn that into cash flow. You want their projects turned to cash flow. And also in the last cycle, the companies that were getting taken out were the companies that were at the end of their debt cycle. They were ready to build. The guys who wanted the offtake were taking them out at that point. So being able to permit, have a pipeline of projects, that's what GoviEx is all about. So we got 3 projects, one in Niger, next to the infrastructure, called Madaouela. It's where all of that uranium came from in Niger. The second project is in Zambia, Matanga. As they've already permitted. And then the third project is in Mali. It's a sort of late stage exploration play. All of those have got their technical studies done on them. 2 of them are public, in the case of Matanga and in Madaouela. In the case of Falea, there has gone to PFS, but it was never published. But we at least have all the technical information. So it just shows you the depth of money that's been spent on these projects and the questions that's been asked of it. So the plan for us is all about putting, firstly, Madaouela into production, and then following it with Matanga, and then much later coming through.
Great, thank you for that. So why don't we get into the PowerPoint itself?
Yeah, all right. So key points, very large mineral resource. We've got over 260 million pounds of uranium in the ground. It makes us one of the largest from a resource holding point of view. We turned our drill rigs off in Niger in 2013. What I'm really saying to you there is we could more than double the resource size. We just didn't bother drilling it because in Niger, for example, which has 110 million pounds of its own, which about 100 is measured and indicated, if you can't make 100 million pounds work, why make it 200 million pounds? No point. So we effectively saved shareholder money by just not continuing to drill. So we have in Niger a 21-year mine life, in Zambia 11 years mine life. They're already scalable with a lot of upside. As I said, you already got the 2 projects.
Yep.
That permitting, absolutely key, which means when the price recovers, which we see it happening now, we're able to action it. We're not going to be sitting here trying to permit projects. And we've already seen in this market what goes wrong if you haven't got the permit.
And so you're talking fully permitted?
Fully permitted. I don't
no
need
more
anything
licenses,
else.
premises outstanding?
All done.
Got it.
All done. And we've seen in this market, in the London market, what happens if you don't get all your permits and you start, notably Berkeley, which unfortunately for them, didn't have what they needed at the end of the day, and you pay the price.
And so in terms of timing, I mean, what are you waiting for?
What we set ourselves out was a strategy which said, look, we've already got the PFS, we need to finish the final FS. We don't need the permits because they're done already. We need the debt and we need the offtake. So what we've actually started to do is move all of them together because the legal bit.
All
so
three
we're moving
projects?
the FS at the same. No, so we're moving all on Madaouela.
Got it.
Moving the FS forward already, slowly, waiting for price to continue. There's, the price has moved up to just under $29 as we speak today. We see that going higher. We need contract prices for this project at about 50. There's normally a $10 difference between spot and term. There isn't at the moment.
So what are you saying? You're saying you're in a bit of a dip in terms of the pricing?
So basically
cyclical?
we're coming out of the dip. The uranium price troughed at about $17 a pound.
Right.
Beginning of last year, it was just over $20.
And what's causing these cycles?
Now you're going into a big longer conversation. If you look at the big picture, in about 2004, well, let's go back, step you back even further. Up until 1985, the market was supplied. From 1985 through to 2011, the uranium market was in a supply deficit, massive supply deficit. What was feeding it was the surplus that had been built up by the Russian and the American governments prior to that, and they were basically feeding it into the market. In 2004, it was very clear that you needed to put more production into place. There was a sort of steady ramp up. Unfortunately, what happened in 2006 is the famous Cigar Lake flood. So that saw the uranium price in 2007 jump all the way to $130 a pound plus, simply because over 10% of the market had just gone offline. And
it was an extraordinary situation.
It was an extraordinary situation.
Right.
So, and this is an industry that's affected by extraordinary situations.
Imagine.
So the price comes down, and we're talking spot. Contract kind of went up to about 75, 80 and just ploughed on. In 2011, of course, we were still ramping forward. Nuclear demand was growing everywhere around the world. The supply was struggling now to keep up. And between that 07, because of that price peak in 2011, a whole bunch of new projects were coming on stream steadily. Cigar Lake coming back as well. The Kazakhs had been ramping up at the same time because they could with their ISR projects and a whole bunch of other different projects. And of course, in 2011, Fukushima happened.
I remember it well.
So Fukushima basically took out 16% of the world's demand within 2 years, gone, which is all the Japanese stuff disappeared. The Germans started shutting down their reactors at the same time, and you then ended up with spare capacity all over the place, particularly in the enrichment side as well. So you had all this underfeeding material coming through as well, and just went into a big surplus. The governments were continuing to sell, particularly the American government, who was trying to cover environmental liabilities of the past, and just put price pressure on all the way down. Projects were being shut down. The problem you got in our industry, of course, is that we have two prices. We have term contracts and spot contracts. So between 06 and 2011, a lot of the mining companies had got themselves long-term contracts driven by those high prices at the time. So they were selling, even though the prices were falling, they were still selling up here.
Yeah.
And we had to go through that pain of basically easing that out of the way. That put more pressure on. So it was a degree of elasticity that you would normally expect to have moved through quicker. Didn't. That has now changed a lot. So what you've seen is a lot of production shutdowns. You know, we're jumping forward onto the supply side of this, but
does that? I mean, clearly a strategic mineral.
Yes.
And heavily politically influenced. And is that? I mean, apart from the situation you just described, do you see any sort of pressure from some of the global activity at the moment with regards to supply and demand? I mean,
no, I mean, the one thing about uranium is there's a lot of it around.
Right.
It's a fairly common mineral.
Okay.
The problem is getting it economically produced.
Always.
So yes, you can have a lot of it, but if a lot of it's not actually worth digging out of the ground, then it just stays where it is. No, I mean, the big drivers, of course, are the security issues for people like the Chinese, who don't actually have any real domestic production. They're going to produce about 1 million a year. They need considerably more than that now and are ramping up demand for it. They've got the fastest build rate out on reactors. You know, it's exponential, effectively almost doubling up every 5 years.
I think we're going to talk about that later in the presentation here.
So that come through. So no, I don't. There are minor issues in the US. We can come back to that as well. There's things like the Section 232 stuff going on.
Right. Okay. Fantastic. And again, you sort of touched upon countries like Germany and perhaps even France looking to denuclearize. But you're seeing a lot of demand elsewhere in the world. Exactly. Even I guess the Japanese coming back online to a degree, slowly, but coming back online. Okay, and so you mentioned a phrase in here which I just want to understand. You talk about a world-class sponsor group, and obviously Denison and Cameco and Ivanhoe, well-known established names. So what's their actual involvement in you?
They all came in as various components. Cameco was actually the first shareholder a major shareholder of the company back in 2008. They came in because Tim Getzel, who runs Cameco at the moment, used to run the Arriva mines next door to where we are.
Okay.
So that's what they invested in early on.
Was that sort of option money, or what was
it? Was at the time. They've effectively stopped putting any new money in since then, but I think very much is going to be, where we see ourselves with our competitors and our sponsors particularly, is that they won't make a decision of their next step, and logically so, until we effectively make that big final financial decision.
Okay.
Because it doesn't change their game until the decision that we make to effectively become a producer.
And when you say like that final decision, you're talking about clearly some kind of exit or getting into production. Yeah.
Are we ready to go into production? We need this amount of money. Do you now want to play the final game, which is, do you want to be part of the production scheme that's going forward? Because why do anything before that?
Okay, well let's start going through the presentation. So we go to page 4. This gives us
4 is
where you're
pretty
operating.
straightforward. It just shows where we are, and I think as I said before, these are mining countries.
Well, tell us a bit about those in terms of things like mining code and rule of law, etc.
Niger is a very interesting one. Its mining code hasn't really changed in a very long time. They've amended it a couple of times, but it's really just tidy-ups. Hasn't really changed since 2006. The nice thing about the Nigerian mining code is that the tax code is built into the mining code.
Is that based on like UK, French?
No, it's French law.
Right, okay.
It's French law. Like most of West Africa, you get a free carry for the government. 10%.
10 at this case, and I know there's potentially
they can buy more, but it's done at fair market value.
Right, there you go. Okay.
So that is fine. But I think the key is that fact that tax code is already built in there. So a lot of countries that you see around the world where mining companies are struggling with them is because the tax codes just keep changing the whole time.
Whether you look in East Africa,
people are negotiating separate tax codes like you got in the Congo. And then why has that guy got such a good deal when this party was in and that party, etc.
So there's no retrospective action expected here. There's some sort of consistency.
No, they actually don't like you negotiating.
We mentioned the political influence.
Yeah, we're in the Sahel. Yes, so it's nice and sunny.
Yes, it is.
I think that I always get asked the Niger question. I mean, which is the security issue. I think
absolutely.
Look, we're in an interesting part of the world, but I think the one thing that you have to take out of this meeting really is that Niger is actually an incredibly quiet place.
Right.
The murder rate in Niger, I discovered this the other day, is actually lower than the murder rate in the US per 100,000 people.
I'm not sure what to think about that.
Well, I know. Actually, you're more likely, and also the same article I was reading, you're more likely to get kidnapped in Europe than you are in Niger. So there you go. Those are international stats.
I'm absolutely stunned.
Yes. But this is perception, you see.
Absolutely.
People's perception is a dangerous place, and it's not. It is a very strong secular Muslim country.
Yeah.
It is very Western looking in its approach.
Yeah.
Works very strongly with its neighbours of Chad and Cameroon to basically police the Sahel. The actions of Cameroon, Chad and Niger were very strong against Boko Haram when Nigeria couldn't deal with it itself. Yeah. They've been very strong in supporting Mali as well in its issues. Niger is a very quiet place to operate.
That's very comforting.
Yeah, and I'm very comfortable going there. I mean, and you have got to be sensible. I mean, there are risks. You're in that part of the world. There are risks, but you've got to be sensible and pragmatic about the way you handle it.
If you know what they are, you can mitigate.
Exactly.
Manage.
One of the things we have done very strongly as well as a company, and the founder, Govin Friedman, before I joined the company in 2009, what he did is institute 100% Nigerian employment strategy that we have there.
Excellent.
So I don't have any expats working there, other than occasionally we have our senior guys like myself or the chief geo go in.
Right.
Review what's going on, make sure everybody's happy. We commit to that kind of approach.
Is that the extent of the CSR activity there, or?
No, we do lots of things. We've supported. We gave $1 million dollars years ago to famine relief. We've just done a whole village got destroyed by floods. We provide water boreholes, things. So in all of our, education for girls in Niger is another strong thing for us as well. In Zambia, we do different things. That fit more appropriately to what the Zambians need.
Okay, well, that's really interesting to know. Yeah.
Big resource, as I said, about £260 million. One of the keys for us is that most of our resource is actually the measured and indicated. So we've actually spent a lot of money upgrading this resource. So if you're looking at your peer groups, some of them got big resources, but a lot of them are still inferred.
Yeah.
Now for us, that's one. You've got to drill 7 more holes to get to a measured from what you had as an inferred in us. So there's a lot of money still to be spent to actually not gain anything other than reduce risk.
Yeah.
So, you know, that is also key of where we stand as a company, that a lot of money's already been invested here. So
what sort of quantum are we talking about?
Well, we've spent in this company today, the whole package, including the ones of $250 million.
Wow.
It's trading at $50 million valuation.
Okay.
So a lot of sunk capital.
That's interesting. And that's all gone in the ground? Well, a lot of it's gone in the ground.
Most of it's gone in the ground. All the technical work that's gone in, all the drilling that's been done.
Yeah, because looking at your burn rate, which again I think you'll touch upon later, it's quite low. Yeah. So it suggests...
We're basically...
Have you been hunkering down in 2018? What's
we've
going on?
hunkered down to a degree, and so far there's no point in spending money on drilling when we have big resources.
Right.
So the focus for us has been very much, what can we do to make sure that this projects are ready for when the cycle turns?
So that's what you want. You're hunkering down to the degree and saying, well, let's wait for the market to come back, the price to pick up.
It's waiting, but it's getting ready at the same time. So I'm not just sitting there, at my home with feet on the desk going, what's the uranium price?
Yeah.
No, we're doing things like, what can I do to the process route that changes it fundamentally enough to bring my operating costs down?
Okay.
What can I change to the mining process? What can I change to the power supply?
Yeah.
And doing the studies that are needed to be done now, so that when we're ready to go, we've already got a $25 cash cost. I'm not satisfied with that. It's got to come down.
So you're looking at optimizing the feasibility.
What can we do about the debt? So that, there's no point in running into the market with a project and say, well, I've got no money.
Yeah.
So we're already working with the debt providers to start structuring that debt, so that if and when the market turns, which we think is happening now, we already have guys. Debt guys aren't fast moving. They're not going to write a check on Friday because you talk to them on Monday.
Absolutely.
It's a 9-month process.
Yeah,
so you've got to work through that stage.
So where are you in that? So are you beginning it?
No, we've already got expressions of interest from a number of debt providers.
And indicative terms?
We are not indicative terms yet, because you've got through the pathfinding process now, so we've got to get the MLAs done.
Okay.
Then we'll get the indicative terms.
Okay.
So, but the fact is, and you probably understand this yourself, debt guys work differently from equity guys.
Absolutely.
Debt guys won't allow you to use their name until you've been through the credit committee. Yeah. So once you kind of get to use
slightly
their
more
name,
cautious, yes.
They've done the review of you.
Yeah.
They're comfortable to be associated with you. So that's going to be a big step forward for us, is when we can come out and say, these are the banks. We've got expressions of interest from a number. We've got to go to the next step.
Okay, so we go to page 5.
That really just highlights the size of our resource relative to our peer group.
But that's you're including measured, indicated, and inferred. What about the others? Is that on a measured basis?
No, they're on everything.
Everything. Yeah. Okay, it is like for like.
It's a like for like, absolutely. So,
that's impressive.
Resource.
That is quite impressive.
Yeah, and as I say, we could easily go a lot bigger just by turning our rigs back on.
But as you say, no point.
No point. It's a big resource anyway, so what's the point?
Okay.
All right. Supply and demand. Really, if you're investing in a uranium company, you've got to get this under your belt first.
So help us understand this.
You don't like the supply demand. Look, let me put it really simple. Fukushima happened in 2011. Sharp decline in demand coming through, had a knock-on effect because you had a ramp up in supply coming through. Deal with the demand side first. Total nuclear generation of energy is now where it was in 2011.
Okay,
so we've got back around the curve. Okay,
right.
We have got 9 of the 50 reactors in Japan turned back on.
Okay.
They've indicated that 20% of their total generation should be from nuclear, which gives you about 30.
So that's written into law, or
that's written into law. Okay. That's what they want to do. Okay, so to get from 9, you've got to get to 30. So there's a whole bunch of restarts.
What's that equate to? What's 20% equal? I mean, what's the Japanese?
Well, that's to say you're going to have another of their 50. They're currently at about 5. Of their 50, that originally 30 have to restart, and you're only at 9. So they're going to be about 10% of world demand when you finish. So you've got to go through those stages still. Expect that to happen. I think this year we probably won't see very many more restart, probably 1, 2 towards the end, just because they've got to go through the changes that need to be made to those reactors by law, and then expect them to continue through. So it's a slow process, but they are coming back. China continues with its very strong growth. I mean, 2 years ago they were down at under 2% of total generation was nuclear. They're now about 4%. Their target as well is 20%.
Wow.
Okay, so strong growth coming out there. What the Chinese have done very well, though, is follow the French model from the past, which is standardization. Just standardize what you do and just keep doing it.
Cookie cutter approach.
Yeah, just don't change it, keep doing it, keep making it. And they are basically as well domesticizing their process slowly. So they're taking the best technologies as they are best to do and coming up with their own designs. And that was one of the problems that happened after Fukushima as well, is that the Chinese stopped their phase 3 developments for a period of time. Well, they did a full safety review themselves of their own designs before they went forward. So, that has been a change.
Right, okay.
If you look at the other parts of the world, Europe as a whole is pro-nuclear. Obviously, the Germanic states, Switzerland, Germany are struggling with it.
Yeah.
France have got currently a strategy of going from 75% down to 50%. They seem to keep kicking it down the can. And the US, which is the biggest fleet out there, of the 440 reactors, just under 100 of the reactors sit in the US. That is the one that probably is the most at risk at the moment because of price risk. It's fighting against cheap gas more than anything else.
Right.
But what you're already seeing is a reality coming through in the US that if you want to remain clean energy, you have got to keep your nuclear fleet and you've got to give them the credits. The same credits that the renewables are getting, or equivalent, has got to be given to the nuclear fleet to stay afloat. You can't, because what you've seen in every country that's got rid of its nuclear fleet and tried to replace it, its carbon emissions have actually gone up. So you look at California, you look at Germany. Interestingly, in Europe, just as an aside, if you look at the relationship between renewable energy and power price, there's a direct correlation. Those with the highest amount of renewables in Europe have the highest power costs in Europe.
But what's your expectation? I think the expectation that's going to come down, surely.
To a degree, but what you're also seeing is that the capacity is flattening off. A vast amount of money has been spent in Europe and in California, and they're basically plateauing out of what they can actually get in.
Yeah.
Part of the problem you've got here is that, look, in the middle of the sunny day, you have a lot of energy and you sell it out cheap. In the middle of December, you've got nothing. Okay,
yeah,
but the problem is that causes a pricing structure problem, which is, okay, who fills up the gap when there's no sun? Who fills up the gap when there's no wind?
That's the eternal argument, but with regards to consistency of power supply, which nuclear can tick that box.
And it's clean at the same time.
And it's clean. It's clean at the same time, but obviously there's again perception issues. Obviously, is why Germany's doing what it's doing and potentially France doing what it's doing.
But
do you think those things
potentially,
vote winning is important?
Yes.
But do you think renewable and nuclear are mutually exclusive?
No, I think the two need to be together.
Okay.
I think that is. The best model is the Swedish model,
which is what?
Which is 50% nuclear and 50% renewable because they've got big hydro, so they actually have 100% clean energy.
But things like obviously coal power fire stations, they've got a really bad rap. But some countries phasing them out, some countries ramping up. But what's your view on all of that?
Yeah, look, if anyone wants to meet the demands going forward of the Paris Accords, etc., it's very clear. And it's interesting. One of the things that occurred last year is that the WNA was actually invited in with the United Nations Energy Council. For the first time, nuclear has been involved in the World Bank policy process, which has never been allowed.
Why is that?
Simply because the World Bank and the IFCs have a complete embargo on talking to anybody related to the nuclear and the uranium industry because of perceptions of the bomb, etc. There's a big difference between the bomb and nuclear generation. All right, fine.
Right.
The supply side is very different. So what you've had is gradual closure of the very high cost mines, those that were not supported by contracts. Contracts are coming off, which is also the key, which we'll show on the next slide we're going to go to. And you've now got to a point where the big producers, Kazakhstan and Cameco, have actually pulled down production to a point where we're now in a supply deficit. Secondary supply...
And that's what, to help the pricing?
To support the price up.
Right,
now the reason for that is that at the current price at under $30, nothing's economic.
Yeah.
Just other, from a long-term development point of view.
For sure.
The other problem that you've got in the next 10 years, is about 20% of world supply will disappear anyway, simply because those are old mines that are coming to the end of their life. So the two mines next door to us in Niger, they'll close up. There's a big project in Kazakhstan will close up as well. Rossing Uranium will close up around that time period as well from its existing deposits. And then even Cigar Lake was actually 2028, it's gone. So the problem that you've got is that you need a much higher price to support the continued development of projects.
Yeah.
So Cameco's made it very clear with their shutdown of MacArthur River, which is 18 million pounds per year and 180 million market. They said, look, this isn't coming back onto stream. This is probably the best mine in the world. It's not coming back onto stream until we see prices with a high 4 in front of them. We need them back where we can contract. And you've got to remember, if you're contracting at those levels, that's because you're committing to sell somebody's material 10 years from now.
Absolutely.
So you know that that's the price you need to keep putting capital in the ground to make sure it gets delivered. So, you know, when we're seeing that, it's telling you that the metal price has got to be a lot higher. That mine will stay out of production until they're comfortable, they get their contracts. At that point, you know, and that's why I'm pulling my costs down as much as I can, because I'm targeting the same place.
Sure.
We've got to make our project work at a similar range.
I guess you're saying that basically the market's going to find its price, and it's going to be managed by some of the big boys to ensure that it can work.
Yeah, and Kazakhstan has basically become the OPEC of our industry.
Yeah.
They're much more flexible, but they've got a price demand.
I mean, like OPEC or unlike OPEC, is that a formal?
It's not a formal statement, but it's a statement from them that they are now value, not volume driven.
Got it. Okay.
Made it very clear.
Okay, interesting.
And they're of course listed here in London now.
So I mean, if we look out to 2035 on current forecasts, there's a significant supply gap.
Yes, and it only gets filled by. It needs price to fill it.
Yeah.
And we did an analysis which basically said you need about $60 to fill that gap.
So you're saying clearly the demand would suggest that the price would have to come on top, because it's not a commodity you can do without. Renewables not going to fill the gap. Gas isn't going to fill the gap.
Correct.
Okay.
Correct. Okay. And that's one of the other issues, which is just covered by this chart on the right on slide 7, is about 80% of all the material bought is actually under contract. Okay. Now the problem you also have coming on here is that the contract market is coming to its end. What they contracted back in that 06 to 011 period, those contracts are unwinding. So if you're a utility, you're like, well, where am I going to get my metal from? I need to contract. Yeah. This is what Cameco is saying is, we'll contract, but it's not at today's price. I need it up here, much higher price.
Got it. Okay. Now, you use a phrase here which I just want to understand when you say the future uncovered utility requirements.
That's the guys without contract. So you haven't covered by a contract.
Not covered by a contract.
And this is the problem the industry has. There's about 40 million pounds is traded in the spot market. About 180 million pounds is consumed every year.
In weight.
Yeah, pounds of weight.
Yeah.
Sorry.
Yeah.
About 50% of that spot contract trade is between traders. Just back and forth,
Right.
So it's never actually gets used by anybody. It's just traded back and forth.
It's a paper trade. Got it.
It's a paper trade. So that shows you the problem that these guys with their contracts have. If you're sitting out here contracting all of this material, 160 million pounds, and you want to find your material and you don't have a contract, you only have a very small pond to go and swim in.
Yeah.
The problem that's happening now is that this year Cameco, who shut their mine, which was contracted, have got to find that contract somewhere else. They're going they need 15 million pounds of contracted material got to be bought out of the market. And the market's only 20 million pounds. Okay, so there's a big hand going into the spot market looking for material.
Interesting.
There are utilities that buy on the spot market all the time as well. US utilities particularly do that.
But they prefer not to, because again, they need
certainty. Some like to play that way.
Right.
Some like the contract. But the problem is going to be, and what Cameco effectively is doing is picking up inventory that's out there. And they're finding out where the ceiling of that pricing is on the inventory and just keep pushing it out and saying, right, take some more. Who's the next guy who wants to sell some material to us in what's their price deck? And so Cameco is just going to keep moving that, securing their metal, they're holding the market in supply deficit, and they're eating the inventory at the same time. So it's a double play on both sides.
Double play, but they're in control.
They're in control of it.
Of the pricing, potentially.
Yeah, absolutely.
Interesting. Okay.
And so where we sit in all of this, which is kind of covered by slide 8, is effectively when the price recovers, we'll bring in the first project, we'll bring in Matawala. That's about £2.7 million per annum. We're assuming that we would be able to go into construction by the end of this year. That's our assumption.
If we started today?
If we start today getting on with we're moving from the process. So we've already started the final feasibility study.
Sure.
We're already dealing with the debt. We're assuming that the price that we need to be able to offtake contract for our project will be achievable within the next 12 months. Okay. If that is the case, then we will make the call at the end of this year to go into construction. Okay. It's price driven. Once that's gone in, then we can bring Matanga in after that. We wouldn't try and build 2 mines at the same time.
Okay, understood. That helps.
And then we have Falea, which is sitting out there as well.
It's an option.
Yeah.
Okay. And maybe so in terms of just on Falea, I know it's a sort of third arm to your story here, but how much effort, time, money, etc. has been spent on that?
That had about $50 million spent on it. It's got a PFS, internal PFS that we had to date, and it's got 30 million pounds of uranium in the ground.
Right.
It's got a very interesting silver copper credit that comes with 70 gram a ton silver.
Right.
It needs to be expanded out from a drilling perspective.
But that's in the background at the moment.
Yeah.
You're doing this sequentially.
Step through this thing as makes logical sense.
Okay. Well, let's get into the first project then.
Yeah, the first one is the Cornerstone, really. This is Matawala. It's next to all the infrastructure in this year.
Yep.
So it's next to the Areva mines. Power's there, roads there, water's there, people are there. They've been mining since 1971, so all the skill sets are there.
Right, okay. How many people do you employ?
We'll be looking at about 500.
Oh, so a significant employer locally.
Yeah, I'm saying. So it starts at 21 years.
Life of mine starts at 21 years, okay.
Yeah, it could be substantially bigger. We start with an open pit for the first 7 to 8 years, then we go underground.
Interesting. What's that do on the IRR then? Assuming initially it's going to be very profitable.
Well, they average out. The underground is very easy once we go in. It's a room and pillar operation 100 metres below the surface in a flat-lying ore body.
Okay.
It's not one of these underground ore bodies. It looks like this is a lot of development.
Yeah.
No, this is, just basically mining out a river. And the main underground ore body is 7 kilometres long by 3 kilometres wide.
Right. Okay.
It's vast, and about 1.5 metres thick. So we just mine it out 6 foot high.
Okay.
One thing that's interesting here, though, is that we start with the open pit, but because we've got so much exploration upside, all we'll do is when we start the mine, just turn the rigs back on again and start looking for the next open pit, drilling it out. And it's probably to the south of us because that's the way the structures work.
But as you say, let's do what we know.
Yes.
There's enough money to be made there, and
once we're making cash, we can start turning the rigs off and redesign everything. For example, in the PFS, what we've assumed is you start with the open pit and you go in the underground. Actually, the way the ore body works is actually you can access the underground from the open pit. So if you could find a second open pit, you'd start the second open pit up and then you'd redevelop your underground straight out of your open pit.
Potentially that helps the economics.
Absolutely.
Right, okay.
So we've got a cash cost here of about $25 a pound, capital at $360.
Yeah.
So what we're doing at the moment, which is kind of covered on the next slide, on slide 10, is actually going through that optimization process. So things like under the current PFS, we assumed that we were going to build the process plant on top of the underground because most of the volume comes out of the underground. Why don't you just move the process plant to the open pit, which is 10k south, start there, deal with it later in the future, because this is the FS is all about optimizing the debt period, not 21 years, because the 21 years is going to change considerably for us because we can go and drill. So we're looking at relooking the process route design, anything we can do to change that. We can bringing in solar hybrid power rather than off-grid power because it's a lot cheaper, those kind of things. We're looking at the debt structuring, so the Medea Capital guys, these are the ex-SocGen team that did Paladin, they did Makuja River, they did Extract. So this is the guys that did most of the debt financing for uranium projects in the last time. The Hulan Loki guys, actually the same guys, same SocGen team, which is why we're using that.
Interesting.
The project sector, we're not...
So and just in terms of I know you have sort of touched on it earlier, but with regards to timing around the offtake,
We'll be looking to bring that together with the debt. I mean, the whole rational reason the debt guys aren't going to come without the offtake. The offtake guys aren't going to come without the debt, and nobody will come without the equity. So,
equity's the...
But the equity, you don't need to deal with the equity until later in the game because it's the shortest path at the end of the day. Once you can show that the debt guys are moving towards where they're happy.
So what's the total?
So we're looking at 360 capital, which about 240 will be debt, 220, 240 will be debt.
240 debt.
So the rest is equity.
Balance equity, and you're expecting to get the equity where?
That will decide when we get closer to the time. So, is that going to be a strategic off-taker?
But if I look at some of your existing shareholders,
it could come. Who knows? I don't know until we get further down the track and we go and approach the existing shareholders and say, "Do you want to play this, or does somebody from the Chinese guys want to come in it?" You know, Niger has strong relationship with Saudi Arabia. You know,
it's unknown. Who knows?
It's an unknown.
Who knows?
I mean, these guys are all looking for supply. It could be, who knows?
Understood. Once you get the debt and off taking place, I guess
but the key question that a lot of people get confused of, they look at the dilution effect today on today's share price. Well, I'm not raising it on today. We'll be looking to raise equity at a point when uranium price is up where we need it, and I can show you I've got the debt.
And you've got a BFS.
And I've got an offtake structure already sitting there, and it's like, you're coming in protected already on the...
It's a bunch of catalysts which should have an effect on share activity in some way.
Correct, exactly.
Great, okay. So let's look at the second project.
The second one's a very simple project. This is Matanga in Zambia. This is a very simple open pit heap leach operation.
Right.
One of the things that's interesting about this one, and it has much lower grades than in Zambia.
I noticed that. And also lower recovery rates.
Yeah, so because it's a heap leach operation.
Okay.
Rather than a tank leach operation.
And it's 11 years.
But very low capital. Yeah. So the all-in cost of these two projects is identical.
Okay.
They're about $36, $37 a pound.
Right.
So they're almost exactly the same.
Okay.
The difference is this project in Zambia has an acid consumption of only about 10 kgs a ton.
Right. What's that mean?
That's how much acid for every ton of rock we will consume.
So that's quite good. You're saying that's quite good?
Niger is 70.
Okay, it is quite good.
Yes, it's 10% of our costs.
Excellent.
And the other difference in Zambia, I'm in the copper belt country. There's a lot of copper
companies
producing acid.
Credits coming up, have you, potentially?
We don't get any copper credits because we haven't got any copper, but what we will get is cheap acid and lots of it.
Got it.
And it's a very low strip ratio as well. This thing starts with like a 1-to-1 strip ratio. All the infrastructure is there for it as well. Yeah. Now again, 11-year life mine, we have this is based on 3 projects here.
Yeah.
Deposits, and then 2 deposits about 30, 40 k's out the road.
Yeah.
We own the mine permit between. Okay. All the radon work, the trench work says, please drill me.
Right.
This can be expanded a lot. So while it starts at 11 years, which is more than sensible for a project, this thing could go out to 20 years.
But you're not going to start spending too much money on this until you've got project number 1 well underway.
Until the market moves up as well. We've obviously, once the market moves along, and the metal prices, we've got to start moving all our projects along. Okay. The biggest driver, of course, is going to be moving Manuela first, because the main driver. This one needs to get going as well to be ready that when we want to go start it, it's ready to go as well.
Interesting. Okay. Thank you.
But it's a very, very simple project.
So here's the section which I usually like to get into some level of detail because I think it's the difference between success and failure. You know, I've seen great teams make very ordinary projects hugely successful, and I've seen very ordinary teams make great projects fail. So tell us a bit about yourself, what you do, and what each of the team members does, and how they contribute to creating value.
Absolutely. I'll say one thing up front. Our team is still very small at the moment. We keep it that way because we like to keep our costs down, and I don't need to have a whole team of engineers. Okay. One of the benefits you have in GoviEx, I'm actually an engineer by background, so I'm a mining engineer from Camborne School of Mines. Okay. When it was in Camborne.
I remember.
It's now moved. I've been in this industry over 30 years now, I'm sorry to say. My first job was actually working at Rossing Uranium. I started production in open pit production. I went into the planning department there, so I went through that whole process of
getting into African mining.
And then I worked to the Northern Transvaal, which is now called Mpumalanga or something. And I was the chief mining engineer for the first open pit platinum mine. I was there when it was a field, and we started up from scratch.
Have things changed over the years in Africa?
Some good, some bad. I think. Okay. South Africa, I think, is still going through its troubles. Figuring out where it wants to go forward. But I think the one thing about Africa is there's just so much opportunity still. I read an interesting article several months ago just showing how the North American gold companies particularly, who are staying in the safe environments, are struggling to keep their resources, build them. Whereas you look at the African companies like Randgold, etc., resources just growing all the time. They're having to take the risk.
I'd agree with that.
But they can find the material they want by taking those risks.
Yeah, I'd agree with that.
And that's one of the things for Africa. So I went into the platinum industry for a while in the Northern Transvaal. So I did that until we got that mine up and running. We came in substantially under budget. I was partly because we redesigned the mine. I redesigned the mine to make it work better.
So your focus seems to be around optimization.
Oh, absolutely. I'm an engineer and I enjoyed the engineering side of it. So I did that. And I worked as a consultant, owning my own consulting company with a friend of mine, doing mine design for other people. At that point, because the guy I was working with, I'd been working with for a very long time, I kind of said, look, I've got to go be a big boy and work by myself. So I went to work for JCI, the old JCI, and I was doing M&A and projects work for them. JCI then died. At the time I was there. There was an empowerment deal that just went wrong. The wrong people were brought in to do the empowerment deal, and it collapsed very quickly as a company. So I then went to work for HSBC as a platinum analyst. I was a rated platinum analyst. I was top 3 within 10 months taking that job on. Why? Because I looked at things in a very different way. I looked at the financing. I'm not an accountant, but it was...
And I guess you had boots on the ground.
Yeah, and I understood how the industry worked. So they brought me over to do the mining houses. So I was then part of a number one global team here at HSBC. Then went to JP Morgan. So that was really useful because it kind of showed you how the money side of this works. You could be an engineer and you fixate as an engineer on this, that and the other, but you actually don't understand how the market works.
It's kind of an interesting point actually, because again, the number of junior mines that we've invested into, certainly you find teams that are either very technical in terms of on the ground, or they're very financial, or they're completely promotional, but very few juniors can afford to have all those skill sets in-house. So I guess having exposure to both finance and mining directly on boots on the ground must have been hugely beneficial.
Well, it does, and we were talking before as well. Having been an analyst for the big mining houses, you kind of get that. But once you get into the junior side, you suddenly realise the importance of market cap. There's no point in talking to BlackRock when you're a $50 million market company.
Absolutely,
it's not wasting your time.
And likewise, I'd argue it's I think. But it's quite interesting when you see management teams who come from, say, a Rio Tinto only experience with no junior experience, expecting it to be exactly the same. And even myself, sort of having invested in sort of institutional side and then come down to junior mining, it's a very different world.
Correct, it is. So I did that analyst work for 7 years, and then I decided I needed a real job. So I went to work in Russia for Oleg Deripaska. I went and joined his basic element group, and I was running 8% of the world's ferromoly out of some very, very old mines there. And then I took on the timber business, which was really hard. I did that until 2008, and then I went into the exploration business in South America, as in Brazil and Ecuador. Then I did underground gold mining in Canada and in Peru. So I kind of cut my teeth on underground mining. I was spending, really tough project that one. I was spending 8 weeks on site, literally underground.
Were you learning from your successes or your failures?
I was learning from the failures at the end of the day. It was one thing I learned is that restarts are really tough things to do, and when you've come into a project that's already struggling, you have got to work damn hard to try and make it work, and that one was just became too difficult to try and...
That's good insight.
You've got to battle it out, but you've got to commit to battling it. Don't as a CEO expect someone else to do it. You've got to go do it yourself. And there are times that you actually have to spend time underground.
And not managing this remotely from 12,000 miles away. I couldn't agree more.
And do it. So that's kind of my background. So this opportunity came out, and I was like, and a lot of the work that we do, I spend a lot of time, even now, scouring through technical magazines and things, looking for ideas. I'm looking. Even now I'm doing something down with the guys in Cornwall on a new gravity system, to saying, how can we apply that to what we've got? I've had consultants always say to me, but it's not proven in the world. I'm like, guys, if I'm just going to use proven technology, the only difference between me and every other project is my grade. End of story. You have got to reach outside and see unless you are willing to take that chance, you won't differentiate.
Have you seen that approach work for you in terms of looking for this edge, as it were?
Yeah, I mean, just simple things can change it though. But unless you actually go and look for it, I mean, we've seen it on this project.
Oh, right. Okay, tell us about that.
When we started, we were looking at high acid consumption. We were looking at, when the original design started, the guys were assuming we were going to grind it and then just do a straight acid leach. I said, why? I got to truck stuff 2,000 kilometers to get here.
Yeah.
Why do I want to truck steel balls?
Yeah.
Those are really expensive things to transport for no real value. So we took this and we've done a lot of work on radiometric sorting, which has been proven now to work. But we look more importantly at that all of the uranium is actually trapped in the cement that holds the sand together. So a lot of our focus is on upgrading this ore. So how can you get that uranium out of that cement, because you can screen the sand away and throw it away. I don't want the sand anywhere near the acid tanks if I can avoid it. And that's where all our process design has been looking at, which is why I'm now looking at gravity, because once you break the cement apart, the density of your cement is about 2 to 2.6 kg per cube, ton per cube. But if you look at uranium, it's like 8.
Right.
So I've got a massive density difference here. When I've done all the work to break it, why not look at that? So this is the kind of thing you got to. Some of it you try and you're like, no, just doesn't work. But if you don't try,
but you're looking to shave costs here.
Always. And not just shave costs; it's to make it more robust.
Right.
As well.
In what way? What do you mean?
This project is in the middle of the Sahara Desert.
Right. Okay.
It's got to be a project that's robust and works in the environment you are in, and will fulfill the requirements that you need in that place. So make it robust.
So who supports you technically then?
So technically, the key guy is a guy actually who works for SRK, a guy called Rob Bowell.
Okay.
Lot of background in the industry. He's consulted for people like the Kazakhs on their IPO. He does a lot of work in ISR. He's worked for most of the uranium companies at one stage or another, but also multi-commodity. And a long history and background. So I use his background a lot, particularly because he complements me by being more of a chemist and metallurgist. I'm more of the mining engineer.
Got it, okay.
But I know enough to be
Where's he based?
Here in Cardiff.
Right, okay.
And travels around the world.
Right, okay.
Jerome is my chief geologist. As you can see from here, a very long history in uranium across the world, knows this industry backwards from an exploration and geology point of view. So I've got a really key guy there to take us forward.
And what's his actual practical hands-on approach to this? Where's he based?
He's actually Mauritian. Surprisingly, he's currently in Niger at the moment.
But he's over in it. So he's actively on this project, not sitting doing it from a computer screen.
No.
Okay, another hands-on guy.
He goes to all of the assets all of the time.
Right.
And this is how we tend to operate, is that he will go in, he'll sit down with the team, come up with a plan on the ground, work with them, but leave them to get on with it.
So what's his brief then? Is his brief, right, I need you to save me costs, increase productivity?
His key area is actually on the exploration side.
Right.
So that's really where I need him to know. Tell me what to do next on these projects, exploration-wise. What can I do to get my best bang for the buck going forward? And understand where we're going to go to next. Okay. So that's really pure geology.
Okay.
Rob's really on the technical side, on the projects, the process side. What do we do from there?
Right. Okay. And then I notice a very strong, experienced board starting with obviously Mr. Friedland.
Yeah. Obviously, the name says it all.
Yeah.
Senator Robert, geologist. He's the founder of the company.
Yeah.
And so he saw that opportunity right up front.
Yeah.
He's obviously got very strong contacts out there in the industry as well, and in the investment industry.
So a geological engineer.
Yeah.
But also a very well established businessman.
Yeah.
Made money for a lot of people.
Absolutely.
Yeah. Okay.
And then we've got David Cates, CEO of Denison. Very pragmatic as a board member, and an accountant as well. So
that's they're obviously a major shareholder. But is he fairly active here, or do you dip in and out as and when?
What I would say with David is that when we have board issues to deal with, he's very active.
Right.
And he's one of those guys, particularly with his accounting background, he's not on the audit committee, but he will thoroughly read all the documentation and give you comments on it. So very strong. Tony Urbanente was appointed by Ivanhoe onto the board. His background is legal, but he's also predominantly does a lot of work fundraising out in the market as well. Not for GoviEx, but for his own. So he gives us a lot of flavour about where we should be looking for the longer term strategy to take forward, and brings a different insight to it.
Okay.
Matthew Lexia is a lawyer, so we use his legal skills when we need them on documentation and stuff.
Yeah.
Chris Wallace is debt. He's a debt financier by background. He joined the company after he'd actually become an investor himself. So he was introduced and is a very pragmatic guy from governance as well. Very strong on governance and how we operate. Benoit Lassalle almost goes without saying who Benoit Lassalle is. I mean, but for those who don't know, he is the founder of Semaphore Gold, which is one of the most best developed gold companies at the time. Has an incredible contact range across West Africa.
I bet.
And that is the key. And he's now in Algold and Windiga, which is his energy one, and he's a company called Earth Alive, which does fertilizers as well.
Okay.
Yeah, so I mean, whenever we need to deal with African governments, Benoit's our go-to man. And if he's not him, he knows somebody who can make sure that we're talking to the right people at the right level.
That's interesting, the government contact, of course.
Oh, it's key. I mean, and a lot of the things, that we have learned, and particularly, and I force on my team the whole time, and the way we did change things is like, when we took on some of the assets from other people, the Canadian company liked to deal with the government stuff. And I'm like, no guys.
Yeah.
You deal with it.
Yeah.
You in Zambia should be in the Mines Ministry's office all the time.
Yeah, I agree with that.
Go in and see them. Just say hi. And just tell them.
Presence on the ground.
You've got to tell them where you are the whole time. I do not want to hear that the Mines Ministry doesn't know where we are on our project.
Yeah.
That doesn't work.
I absolutely agree with that. And we've had some bitter experience last year of a company we've invested into who didn't do that.
Yes.
And have regretted it.
Oh, absolutely. And we do that in all of our countries.
Yeah.
That's exact. The face of GoviEx in Africa is actually the local guys.
Yeah.
My job is to make sure that everything's controlled from above, and I turn up when I need to turn up.
Yeah.
And then Robert Hansen.
Again.
Yeah.
Well known in Africa.
Well known.
Yeah. I mean, what I notice here, though, is that you've got a finance guy, a lawyer, another lawyer, a finance guy, an accountant, an investor. It's very much about how your business should be run, because it says to me you believe that technically you are where you need to be between Govind, yourself.
Yeah, and don't forget, Benoit has actually built a company.
Yeah.
A gold mining company.
Yeah.
So he brings enough understanding of how to build a company himself in the industry.
Right.
And the next stage for us is going to be about building that technical team up under.
Well, so I guess that's my question here is, obviously you're at the stage you're at now, but to move forward, and if you're going to get into production, I guess there will be changes in terms of the board.
We'll see changes
NEDs.
Across everywhere, and we'll have to build up a technical team.
Right.
And not just a technical team, logistics, procurement, all of these things, but I don't need them now.
Fine.
I don't want
and you
to
want to keep the cost down. I
get
get it, but you're aware,
absolutely,
and you know that's coming down the line.
And it will probably be here in London, because it just makes sense. There's no point in trying to set up a whole mining team out of Vancouver when the projects are here in this part of the world.
It begs the question. I think I know the answer. Mr. Friedland. Mr. Friedland is the answer why you're TSX and not on AIM.
Yes and no. We were on the CSE. We went to the CSE originally because it was a cheap option.
Sure.
When we first did it, and then actually when we did the transaction with Denison, we actually reviewed both sides.
Right.
The AIM basically was going to cost us £500,000.
Yep.
And it cost us $11,000 to go onto the TSX-V.
Did it?
Yes.
That's interesting. It wouldn't cost you that now.
No. The TSX-V approached us and said, because you remember the CSE follows the same rules as the TSX-V.
I know.
Same set of rules. And they said, you're already doing all of the stuff you need to do, all the public disclosure. In fact, they have to do a monthly report on the CSE, which you don't have to do anywhere else.
Yeah.
Quarterly financial reporting.
I know.
And so it was a case of, do we want to spend £500,000?
Yeah.
Or $11,000?
Yeah, I think we know the answer.
Correct.
Yes. So let's get into some of the numbers around the business.
Slightly updated version for you.
Thank you very much, sir. So we obviously know who some of the main shareholders are. So again, begs the question in terms of
that, it's about 50-50. retail and institutional.
From where?
Oh, geez. Pretty evenly spread Europe and the US and Canada. I've got a lot of European retail. I've got a lot of European. We raise quite a lot of money when we do our fundraisers out of Europe.
When you say Europe, where we Germany?
Germany, Switzerland, Scandinavia, London.
And London.
Yeah, absolutely, all of those. And then we actually, what is interesting, and it's quite an interesting insight to us. We in 2016, 2017, I got an OTCQB listing, and I got the DTC eligibility issues dealt with.
Okay.
Now that's important from a US point of view because it's all the disclosure. For those that don't understand why we bother doing that, but it allows a lot more brokers to access the information and trade your stock by doing that. Also made us CRIS compliant, so we can actually go to people's ISAs in the UK.
Yep.
So what is interesting is that we also trade a lot of volume now through the OTCQB. Probably about 25% of our shares trade on the OTCQB. So it's not a dead exchange, which shows how many people are actually trading on the US market for us.
That is interesting.
Yeah, so we're fairly liquid. We trade.
So who covers you in North America? No one.
Nobody.
Not covered. But you're still getting 25% of your.
We don't have an analyst. I just do a lot of work.
Very good.
Marketing.
I'm impressed. So market cap today is sitting just around
it's about
56.
50. Yeah,
Canadian.
We got just over $1 million of cash, and we have.
What's your burn? When's that going to last you?
Hang on, we got $2.8 million to be paid back to us this year, which will all be paid back by June, as well. So that
paid back by
a company called Linkwood. We did a transaction last year which saw us remove a $10 million loan for $4.5 million, and it was a uranium-linked loan. So we took it out at half.
So are they good for this?
So they're good for it.
Okay.
And we've confirmed the repayment clause.
And so when was that for?
Sorry.
When's it due?
It'll all be paid back by June. It's done in tranches starting in February.
Okay, fair through.
So it's not, we're not waiting.
Equitable tranches.
Yeah, almost. Yeah.
Okay, interesting.
There's a press release on it by now.
Fantastic. Okay, we'll just check that out. Thank you. Shares, you've got a bunch of warrants. Any warrants coming?
If you jump forward all the way to page 25, because it's a slide I get asked for.
Okay, so let's talk through some of these.
Warrants. I mean, the interesting bunch. It's got a whole bunch of warrants due this year by the 10th of June. They have a call on them if the share price remains up over 20 cents Canadian for more than.
Well, I've seen it. There's a few. There's greater than 24 cents, 20 cents, and what is this one?
The clear tranches, the ones to be interested in are obviously the ones in
these four.
Yeah, because actually just those ones, the first three.
Just the first three. Three. So they're in the money.
They're kind of on the edge at the moment. Yeah. Actually, they're out of the money as of today because the US share price is about 12 cents.
Dropped. Okay.
Yeah, it fell. We had a bit of a hammering over. So now is a great time to buy GoviEx.
So what was
with the whole market?
You had a bit of hammering. Why?
No particular reason. The whole market got hammered. So most of the uranium stocks got thumped over Christmas.
It's a good time to buy.
It's a great time to buy. Yeah.
Okay. Those warrants potentially coming through, which will deliver
about 7 million.
Right. Okay.
Yeah, assuming they get exercised, so we'll wait and see.
Got it. Okay, fine.
So we're watching those as well at the same time, but that provide a lot of the
That
financing.
kind of explains that.
And then the rest are tranched up. We try and keep them quite short dated, and we try and have them with escalating prices on them, so that force people to try and reckon.
So what you're saying on this basis is that you're not looking to go back to the market to raise any money
not in the
anytime
short
soon.
term. No.
Okay, fine.
We obviously will as we move forward. If the market gets stronger, then and we're going to need to be more aggressive on where we are on the project.
Sure, but there's no dilution at the moment.
No, not planned at the moment.
Okay, and we've talked about some of the catalyst events coming through.
So I mean, really,
let's get
the other slide, really the final slide in this discussion is slide 15, which is again, that's the key story for me from a value point of view, which is what I've tried to do on this slide is really just show there are two groups here, and this is where we are different. The chart on the left-hand side is the producers.
Yep.
The chart on the right-hand side is the developers.
Right.
GoviEx is sitting as an undervalued developer in its own right. Now, there's many reasons for some of that. You could argue, your next-gen, your Fissions are all the high-grade North American stocks. The difference between us and them, I would argue, is that I'm permitted. You know, as I sort of say to people, you can own a Ferrari or you can own a Ford Mondeo. This Ford Mondeo will take you shopping. This Ferrari will stay in its garage and won't do anything for a very long period of time. That is the reality of where you are. This is potential to be a cash generator.
Right.
The other thing I would say, you know, while we don't develop this company and we're not developing this company to be a takeout story, we're here to be a builder.
Okay.
But you never know in the world when things happen. Interesting, in the last cycle, the 3 biggest transactions all happened to be in Africa. The smallest was $1.2 billion for a company with 100 million pounds of uranium in the ground, which is Tanzania, which is Makuja River, uranium 1.
Interesting.
The other 2 were $2.2 and $2.4 billion transactions for companies about our size.
So what's happening here? I mean, in terms of a multiple on share price, I mean, people are achieving what?
Well, at that time, they were the sector was different back in 2011, 2012. So I'm not kind of saying things may, you know, you've got to put this in context. But even if we got half the value from where we are now, that's a big step up. The point I'm really making is don't be afraid of Africa. The reason those transactions took place is because the guys who came after those projects, which are the Chinese and the Russians and the French, wanted to control supply. They can control supply out of the African projects. They can own 100% of them. In Canada, there's the 49% rule. You can't own more than 49%. So that's why they came to these projects. They were more concerned about getting their hands on physical uranium supply. And we're seeing that to continuing. CNNC's recent transaction to buy Rossing Uranium at the end of its life. Okay, so
as a developer, you're saying you'd argue you're underpriced.
Correct. The other point that I would make is I'm one of the few companies that can go from the right-hand side to the left-hand side in this cycle. Most of these guys, 5 years from now, will still be developers. GoviEx is probably going to be a producer, and that has a natural re-rate coming with it at the same time.
Okay.
So that is the difference between us and our peers.
Understood.
And there is, you know, this has been done before. Paladin did in the last cycle. They went from between 2005 and 2007 from 7 cents to $7. What did they do? Built 2 mines in Africa. So.
Okay. Right, and maybe just the last couple of slides here.
Very much what it says on the first slide. But I'm a great believer of tell people it, tell it again, and tell it to them again. So I mean, really,
big fan. So
the story is strong shareholder base, with out there,
but not necessarily active at the moment. But could be.
But it shows you the kind of assets that we've got. That these are the kind of companies that got involved.
See, with the right names.
Correct.
Okay, got it.
We've got experienced management. We've kind of done it all over the place. We've got a really big resource.
Yeah.
Okay. We've got a lot of exploration upside.
Yeah.
We've got those mine permits, which are key. So if the market is recovering, it's that ability to turn that into cash flow and build mines and get that re-rate coming through from it. Those are your big triggers here.
Thanks for running through the presentation. I mean, it'd be great if you can also highlight where you think you're creating real value for investors. I mean, where you're talking about being undervalued, okay, in terms of the developer, and perhaps even a re-rate as a producer. The market is depressed. You've taken a bit of a hit recently, along with a lot of other people. So you would argue that share price is less than it should be. But what are you doing to create incremental value in 2019?
Well, part of it's doing what I'm doing here today. It's all about getting exposure for the company and explaining the story to people. The rest of it is what we've done there, which is that ability to add value to the projects themselves. My job ultimately is to be able to make sure that when this market recovers, this company is ready to build its assets.
Right.
That's what my job is. And the ways to do that is effectively bring down the incentive price that I need to get this thing built. This project cannot be a project that needs $50. Let's make it a $45 price that gets this project going. That's what adds value, because if you can get this project up and running, and I can get the cost down lower than the $25, and I'm running at that price, I really don't care what happens after that, because this is a long-term project that's going for 21 years to start with, has the cash generation to build. I've de-risked this company, generating cash flow going forward. That's how we add value here, is basically turning these assets into producing mines.
Okay. So, and again, one final question. In terms of the audience you're talking to today, It's a retail investor audience, high net worth, family offices. I mean, what do you want them to go away thinking about GoviEx and indeed yourself?
I think the things you've got to go away as an investor to think about is, one, do you believe the market? That's the key. If you believe in uranium, you've got to believe in the uranium story and get your head behind that and why it's different now and why we see the growth going forward. And I think that understand that Cameco story. That's the key. That's what's driving this market at the moment to start with. Why it's different, because that wasn't there before. From a GoviEx point of view, you can see we're a company here that has got a massive resource. We've got projects, but more importantly, they're permitted projects. That means a lot in our industry. If it's going to take you 6 years to a permitted project, think of the dilution those companies have still got to go through for the next 6 years. They can't do anything. And then they'll start the construction phase after that. So you're probably talking 10 years before some of those companies ever see the light of day. Don't be as scared of Africa. Africa's a great place to operate. It's pragmatic. It understands what it's doing. It's out to create wealth as a continent. So, and there's 54 countries in Africa, so don't cover the whole of Africa with one paintbrush. Doesn't make sense. From our technical team and myself, we've been doing this for a long time. We've done it before. We know what we're doing out there.
That's great.
Okay.
Thanks very much.
Pleasure.
For that recap on your story. We look forward to hearing more in the coming weeks and months.
Always a pleasure.
And we will hope to see you soon.
Thank you. Cheers.
Thanks again.
Take care.
Cheers.
Cheers.
Thank you very much for watching our video. We do aim to give you informed and intelligent information with which to make your investment decisions. So if you liked what you just saw, please give us a thumbs up. And if you want to see more insightful, in-depth, honest and unbiased interviews, then please click the subscribe button. So thanks again for watching, and we look forward to seeing you again soon.